afternoon and welcome to Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Direct. Very good afternoon, Pankaj, and thank you so much for joining in.
Hi, good afternoon, Gitu.
Pankaj, we had another volatile week with Nifty gradually inching lower in absence of positive triggers. Nifty lost around 2.7% during the week, with Bank Nifty losing around 3%. None of the sectoral indices actually closed in green except for the PSE index, which was marginally higher. It was only India VIX that moved higher by nearly 7.5%. What next? Don't you think that weakness is overdone now?
So, well, yes, like you said, we have seen market sort of declining shade over 2%. And this is in line with what we are seeing in global markets. I think since highs, we have declined about 8 odd percent. And largely because of the fact that the commentary from most of the central banks, especially Fed, continues to remain hawkish. And which is why there is an expectation that probably the higher rate cycle will be there for longer than what people or we all have sort of anticipated.
Right.
And our sense is that market is going to be sort of boxed in a range of say 17,200 to 1800, 18,000 kind of a level. Obviously, market looks oversold. So yes, there is an expectation that probably things or you could see a bit of a bounce because we have seen some of these sectors like say banking, heavy short rollovers have happened even next month. So in case if there is some bit of a reversal or short covering there, so probably some kind of a move is what we can get. And historically, we've seen that whenever we see, say, Nifty or market sort of declining for 3 consecutive months,
Okay.
after that, the market usually produces 4 to 5% kind of a gain. So even with that logic, also at best we might be sort of heading towards 18,200. But I think that is still some time away. Largely, the expectation is that the market is going to be boxed in this range of say 17,200 on a lower side and 18,000 on a higher side. And this is not because of heavy FI selling, because FIs have been sort of buyers to the tune of about 3,000 odd crores in this month of Feb. So it's not because of high FI selling. It is largely because of the jitteriness of the US Fed actions, and that is sort of causing a lot of anxiety in the markets at this point in time.
Pankaj, retail investors are slowly moving out of the market because most probably most of them haven't seen such kind of a long consolidation, and then markets not reacting to any of the positive or the negative news. It's holding back. So what is your advice to the retail investors who are still holding on to their portfolios, expecting the markets to give a big bounce back?
I think in see from an investor perspective, what needs to be seen is that see, for example, last 2 3 years we've seen good bump up in earnings. But when you sort of look at say October 21, we had similar levels of market, and it's been 1.5 years we are at the same level. So the point is that market price performance and the earning growth really do not sort of in a shorter time frame would not really sort of have a linear equation. So it is
Okay.
possible that the markets may not do anything, whereas the earning growth could be in the double digits, which is what we have seen. And vice versa can also happen is that probably next 6 months we may not see that kind of earning growth, but price performance can be. So obviously, one needs to sort of take into that account. There could be a period where you will not see price performance, and while earning growth and everything will look sort of quite good, which has been the case in this particular quarter. I mean, contrary to expectation, the Nifty EPS is 205 compared to 195, which was the expectation. So obviously, there is an outperformance. But we are not seeing market sort of performing. Banks which have come out with best set of numbers, post that we are seeing a sort of a
True.
correction. So that is very normal thing to sort of happen in market, and which is why time in the market is more important than sort of looking at timing the market. So one needs to be there in the market for durable period of time to sort of reap the gains, because in a longer term, markets will toe the line of the earning growth. Until the time earning growths are largely in shape, will not be worried.
Is it the time to really rebalance your portfolio, move out of the sectors that you don't think are going to perform in times to come?
Well, yes, I think we have seen some of the high P multiple names. I mean, be it the kind of Relaxo, Asian Paints, or a lot of other names where so some of these stocks are sort of priced to or were priced to perfection. Now the
Okay.
challenge is that, say for a company like Relaxo, which was making say gross margins of 60%, and that sort of comes down to say 48 odd percent. That's a
Mm-hmm.
sort of a significant decline in gross margins and consequently EBITDA and profit margins. So
Mm-hmm.
when the stocks are priced well, if they sort of falter, you see the kind of damage, what one would see 30-40% kind of a bare minimum decline, and which
Okay.
is a sort of a challenge. But like I said, not all stocks meet the same fate. You look at Trent. I mean, it is one of the few stocks which is priced quite well or priced to perfection, but they have delivered the highest CAGR of 36% among domestic retailers. So I think
Okay.
one needs to be watchful of our growth. But having said that, one needs to look at a lot of other sectors. Say, for example, traditional oriented sectors like say power, steel, or oil and gas. Because see, last 6-7 years, what we have seen is that you have only seen the high growth names sort of getting higher multiple, and that is where the value
Right.
creation happened. But now the
Right.
economy sort of moved more of broadening up. So from that perspective, opportunities are there in other sectors, and which is why people need to sort of rebalance some of these high P names with some of these traditional names. So, for example, in traditional names, we like something like NTPC.
Okay.
One, if power demand is going to be higher, you'll see higher PLF, and consequently, company will benefit. ONGC
Mm-hmm.
with 8% kind of a dividend yield is trading at 4P multiples. The company is talking of 4, 5, 6% kind of a production growth, something
Mm-hmm.
which has not really happened for a good period of time. So
Mm-hmm.
probably these are some of the names, or the beaten down names like in auto, say for example, Tata Motors or
Right.
Maruti. I think so. There you have both volume growth plus margin expansion expected to happen.
We had geopolitical tensions emerging once again, and now we have El Nino occurrence, which is being expected this summer. So, what is the kind of impact that you see of below average monsoon on the consumption pattern in India?
So I think there are two things. One is the temperature is expected to be slightly higher by 2 to 5%, contrary to what we see. So there is a early summer onset of early summer. Then
Mhm.
obviously there is a 57% chance of El Nino occurrence, and that happened in 2006, 2009, and 2016. Obviously,
Mhm.
that can lead to lower rainfall and consequently impact on a lot of agri commodities, be it wheat, be it sugar. And one obvious impact will be that lower production and then prices will sort of inch up higher. But a
Okay.
bigger damage could be in terms of the rural consumption. Rural consumption has been struggling for quite some time because we have seen 6 to 7% kind of a decline. That is what the latest we sort of pick it up from most of the FMCG companies. So
Mhm.
obviously, it will have impact in the FMCG categories because most of your companies like say HUL, Dabur, Marico, all of them derive 30 to 50% of their top line from the rural side, and if that gets impacted, so probably it will prolong the recovery in the rural consumption. So obviously,
Okay.
that's a sort of a negative impact. But there's
Mhm.
some positives also, or silver linings also. So you have companies like, say, Varun Beverages or Zydus Wellness, I mean,
Yes.
which have got a strong summer portfolio. So ideally,
Mhm.
that should sort of do well because for them, next quarter is one of the most important quarters from a volume growth perspective. And
Mhm.
similarly, when you look at consumer durable companies, I mean, we have already
Yeah.
seen AC companies sort of or cooler companies
Yes.
doing sort of slightly better. So obviously,
Mhm.
early onset of summer can benefit the entire lot of room AC or air coolers or refrigerator and fan as a segment. And which is
Mhm.
why we like something like Havells, where we are expecting about 15% kind of a volume growth next quarter. So that's a buy
Mhm.
recommendation according to us.
Mhm.
Voltas is hold because it's a single product segment company. So, but AC as a segment should benefit. Two-wheeler
Mhm.
again would lag because we are not seeing the kind of
Yeah.
growth what one would see in the two-wheeler pack. And if rural consumption gets impacted or income
Mhm.
gets impacted, so then I think the entire two-wheeler as a pack, they haven't done anything. We have hold rating on both, say, Hero MotoCorp and Bajaj Auto. So I think
Mhm.
probably things will be slightly difficult for them. So yes, there are some positives and some negatives. But
Mhm.
state-wise also, one needs to see that, say, for example, state like Uttar Pradesh or Punjab, so they've got decent irrigation facilities. The ground table is quite better, so there we may
Mhm.
not see that kind of impact. But
Mhm.
on a pan-India basis, yes, we'll see an impact.
What is your view on the banking space right now? Because we have seen a decent correction in all the PSU sector banks as well as the private banks. Is it time to really accumulate some of the good names as far as the banking space is concerned?
Yes, absolutely. So I think banking, be it PSU or be it private banks, they came out with one of the best set of numbers in last quarter, and we've seen say private banks declining by 10 to 12 odd percent. PSUs have actually declined even more at 15, 20 odd percent. So obviously
Mhm.
this current correction offers a good sort of entry point. And we prefer large players across whether it is PSU or private. I think credit growth is expected to be 12 to 14 odd percent, will be lower than 16, 17 odd percent, which we are going to see in FY23, largely because the base has become higher. So you'll see lower sort of growth. But I think asset quality wise, no major challenges expected. ROAs are expected to be healthy. Margin profile is also expected to be healthy. Probably next quarter, we might see 5 to 7 pips kind of a further improvement in NIMs, and it
Mhm.
might sort of stay there. So nothing changes from a fundamental perspective. It is just that these stocks have rallied, so we are seeing profit correction, and which is why preferred stock could be say SBI target price 100, 700, sorry, and companies talking about 14 to 16% kind of credit growth. Uh, FY25, it's trading at zero point 0.7 times. Looks good to us. Similarly,
Okay.
Axis Bank looking to sort of deliver 5 to 6% higher credit growth compared to industry. Profit
Mhm.
should grow by 29% because largely provisioning requirement may not be that heavy.
Mhm.
And HDFC Bank, so while merger is obviously one of the uncertainties related, but our sense is that post-merger bank should do well because
Mhm.
they're building on both the physical and digital capabilities. I mean, they're looking to
Mhm.
add 1,200 branches every year over the next 2, 3 years.
Mhm.
And yes, this is one of the few banks which has been a very steady performer. So there, the target price is 1920.
Mm. Pankaj, I remember when GST was launched in India, we were very gung ho on logistic companies as such. But if we see the last past 1.5 years, these companies haven't done so well as far as the price movement is concerned. So, what is your outlook for logistic space as such?
Well, you're right. So we have seen a pretty rough quarter from most of the logistics companies, and price-wise, yes, the impact is even more. So we have seen, on an average, about 17 odd percent kind of a decline in whatever stocks we track. In fact, the front lines have declined more, closer to about 30 odd percent compared to smaller caps. Now, the decline in frontline is largely because of some of these specific issues. So one is when you sort of look at a company like Adani Port, one, the EXIM volumes have been soft because global growth is not being there. Then there was also an issue of container availability. So that sort of had an impact. So which is, and then you have the entire issue with all the Adani group of set of stocks. So that sort of impacted. Concor
Mhm.
is also a player on the EXIM side, so they have lost some market share again because of the lower container availability. Plus, most of these companies have been in a capex mode, so obviously that impacts. But when
Mhm.
you sort of look at the some of the other express companies like CTCI, TCI Express, I think most of them, while they might have a softer quarter, but most of them have indicated strong margins for Q4. I think
Mhm.
except for Mahindra Logistics because they had acquired one B2B company, so obviously they are going to sort of take that cost.
Mhm.
But in general, our sense is that as the trade normalization sort of happens, Q4 should come back strongly for most of the companies.
Okay.
From a GST or from a structural perspective, we continue to like all of these companies. I mean, look at the budget. 50% of your capex is towards road and railways. I mean,
True.
the primary objective is to reduce the logistic cost, which is one of the highest, because for manufacturing to succeed, the
Mhm.
logistic cost needs to be brought down from say 14, 15 odd percent to single digits. So I think
Mhm.
that is what the budget is sort of aiming. So I think structurally things are good. It is just that because of some stock specific issues and also because of this exim issues, some of the companies have had rough quota. So from that
Mhm.
perspective, I think we like most of the names, uh, and these are sort of good levels to sort of accumulate for the next 2, 3 years.
Mhm, mhm. Pankaj, you just spoke about Tata Motors. Is Tata Motors a turnaround story because they also have a fundraising plans and good capex plans? as far as the future is concerned. So, would you throw some light on this fundraising plan and how you see Tata Motors really turning around, uh, and then we see a price movement happening for this stock?
So for Tata Motors, we have seen one of the most highest positive revisions in earnings post last quarter. One, because we have seen margins improving across categories for this company. Now, we have seen Tata Motors looking to now raise about another $1 billion, and which again could be at a premium of 15%. So,
Okay.
so valuing the EV business at about $10.5 billion. Last raise was at
Mhm.
about $9 billion. So this is roughly 15% premium. But when you
Mhm.
sort of take into account the rupee depreciation, so it's actually 25% kind of a premium to the previous valuation. Now they're
Okay.
talking of $2 billion kind of a capex for EV. So $1 billion they had already raised earlier, so which is what will be required for the initial phase. Now
Mhm.
Tata Motors has also given a guidance for becoming net debt free, excluding the Tata lending book what they have. So I think this money probably could be used to some extent for that. So I think company is making or walking the talk in terms of whatever they've been sort of saying, except for 1 or 2 quarters where because of global challenges, JLR could not sort of really perform on the expected lines.
Mhm.
So which is why we have a target price of 530 now. One third of the price is now residing in the EV business, and it will get even more higher. So from 160 rupees per share, post
Mhm.
this fundraise, this will become 200 rupees per share. So I think
Mhm.
this is one stock. Our sense is that if nothing goes wrong for globally in the next 1 or 2 years, should really outperform the Nifty by a sizable margin.
Okay. We had a Z story coming out this week. Z headed towards NCLT, but on Friday got some relief from the tribunal, which has stayed the insolvency process for now. How do you see the story panning out for the Z Group companies?
So I think the challenge is that the Z's exposure sort of continues to haunt. I mean, the kind of related party transaction they had, so continues to sort of haunt this company even now also. And
Mhm.
now, thing is that they had sort of guaranteed a loan of 150 odd crores, so which is why IndusInd Bank is sort of looking at going to NCLT. Now, the
Mhm.
challenge is that while the company has a sizable cash on the books of say 750 odd crores, so they can sort of pay this amount.
Mhm. Mhm.
So it's not the amount which matters, but I think the challenge is that if these issues sort of keep cropping up, then I think the challenge will be is that we may not really see much of a price performance. I mean, see, previously we had a buy rating on the stock with a target price of 260. Now, the
Okay.
perspective at that point in time was that you'll see a bigger entity
Mhm.
across sports as well as the OTT as a segment, which can
Mhm.
command good advertisement revenues. Now,
Mhm.
if these issues still sort of keep coming up, then obviously the anxiety gets created in terms of whether the merger will get delayed or whether things will become challenging because now NCLT meeting for the merger is also sort of slated for next month. So
Right.
now you have a bit of uncertainty. And
Mhm.
which is why I think, though we were holding a positive view, but I think it's now a cautious watch on the counter for quite some time till the clarity emerges because now the stock is below 200 levels. So it's taken
Mhm.
a good amount of beating. So I
Right.
think till the time this related party transactions or the past issues with the associated or group companies don't get sorted, I
Mhm.
really do not see stocks sort of performing anytime soon.
Mhm. Now it's the time for hidden gem. So, which is the company that you're going to talk about today, Pankaj?
So I'm very selective in terms of giving out names largely because it's a sort of a stock specific market. In general, not
Mhm.
all sectors are doing well, but I think capital goods is one sector which is sort of holding up well.
Right.
And budget also has been sort of pretty pro capital goods sector. Now,
Mhm.
so ABB is what I am recommending here. Our target price is 3735, so it's offering an upside of about 18 odd percent. Now,
Mhm.
most of it is known for the company. So this is one company which is a leader in technology solutions across electrification, robotics, automation, and motion portfolio. Now,
Mhm.
this company is a good play on electronics, railways, metros, data center, warehousing, and all other core industries and the revival of the capex cycle. Last
Okay.
quarter, they had one of the best quarters, so pretty strong performance. Revenue grew by about 16 odd percent. EBITDA margin also was pretty strong at 15 odd percent. And obviously, profit growth was good. Order book inflow was sort of 4%, but largely initial quarters, you had seen a decent order inflow. So for example, calendar year basis, the order inflow was still quite good because not all quarters you will see a linear growth in the order book. So our sense is that this is one company which will continue to sort of deliver good double-digit top line, bottom line growth. So revenue growth is expected to grow at 19 odd percent, EBITDA at 26%. The only negative is that the stock is expensive, but that is been the case with most of your big MNC plays on the capital goods side. And we really
Okay.
do not see these stocks correcting from a P multiple perspective, because while the P multiple might look higher, but the kind of order inflow which can happen, probably these multiples may not really look expensive from a 3-4 year perspective. It's a
Okay.
portfolio stock, so which is why we feel that it's a good place to be, or a safer place to be into at this point in time.
So the hidden gem for this week is ABB, target price of 3735, an upside of 18%. This is the stock for your portfolio. Please don't play it for a very short term. It's a portfolio stock, so you have to hold for long term for sure. I know it's a very difficult question to ask Pankaj, because markets are going nowhere. So what will your strategy be for next week?
So I think while Nifty is not doing much, but yes, it is possible that we may continue to see stock-specific move. So I think one is you will have auto numbers next week. Our sense is that auto numbers or wholesale numbers should come out good for companies like Maruti and a lot of other players, because now you'll see the full impact of demand sort of coming in. And then the
Okay.
chip shortage issue is also sort of easing up. So we're sort of keenly waiting for that. And then I think pharma is one sector which is sort of resilient. So our sense is that when you look at last week, we've seen defensive sort of relatively doing well, beat IT, beat pharma,
Right.
and beat FMCG. So pharma is one sector which hasn't seen much of a price performance, has been relatively resilient. So from that perspective, I think pharma looks attractive. Again, something like Dr. Reddy looks good. Otherwise, I think if we get a short covering, then I think the entire banking as a lot will become a lot more better, and that might help Nifty to sort of sustain higher levels of say 17,800. But overall, market is are expected to be boxed in a range.
I know it's very difficult to talk about markets these days because it's a range stuck market going nowhere. No triggers are really helping. Even if it's a positive trigger, markets don't react. Thank you, Pankaj, so much for your time and sharing your views on the market.
Pleasure interacting. Thank you.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.